Here's the problem that has affected so many people I know. They put all their money in equity. It makes sense, that's the asset class they understand. And what happens is the equity market doesn't go anywhere. It just trades in a range. So they're getting the dividend yields a couple of percent, and this isn't the type of returns they really expected. Or worse still, what's happening is the equity market is actually going down. It's in a bear market. They put all their savings in equity and they're just losing money every day. And this is totally soul destroying. And what they want to do is have a portfolio which makes money when the equity market is going down, or at least a portfolio which delivers you something when equities are in a bear phase. So this really raises the question, should you put all of your funds into equity, or should you look at some asset classes instead? Now, I think clearly it's worthwhile looking at some other asset classes. It's really difficult when the equity market's going down, however good a stock picker you are, however intelligent you are, however focused on the market you are, for you to make money. Yes, you can be trying really hard, but chances are the best outcome you're going to get is that your portfolio might be going nowhere. So in this video, what I want to look at is some of the asset classes that you might buy which will enable you to do better at those times when the equity market is either trending nowhere or going down. Now, I spent 30 years in financial markets, and over that time, I figured out lots of different strategies to make money in all sorts of market environments. We're going to go through some of those alternatives here. Now, I'm showing on the screen here some of the other asset classes you might buy. You don't have to just invest in equity. I'm only going to cover 4 of them, but let's just have a look at some of the options available to you. Now, you can buy property, and you can do that in 2 ways. You can either buy it through the REITs market, which is basically the equity of companies which hold property, or you can just buy property yourself. If you want to buy property yourself, you can buy residential property or you can buy commercial premises. Either are up to you. You can also buy government bonds. Now, government bonds are bonds issued by the government. So if you're in the United States, they'll be issued by the US Treasury. If you want to buy bonds in the United Kingdom, they'll be issued by the British Treasury, or of course, France, Germany, other developed countries issue bonds as well. And bonds are not like equity in that you get a fixed coupon. This is typically the way they are structured, that you pay a certain amount of cash up front, and then for a number of years, you get a coupon in return, and then when the bond matures, you get your money back. Bonds are therefore quite an attractive alternative to equity, and in another presentation we'll go into some more detail as to how they work. You can also put your money in the bank. You can put it in cash deposits. Obviously, you're not going to make a lot of money by doing that, except when interest rates are very, very high, but it's a stable and relatively secure way of protecting your cash. It's very unlikely the amount of money you put in the deposits is going to go down. Now, of course, the big risk here is that the bank could go bust, and not all deposits are insured, but in general, that, at least in the short term, is quite a safe way to store your money. There are other more interesting things you can look at as well. There's corporate bonds. Corporate bonds are bonds just like government bonds, but they've been issued by a corporation, which means typically you're going to get a slightly higher return, but the likelihood of being paid back with the government is almost certain, at least for a developed government. For a company, it's certainly not guaranteed, and there are slightly higher risks you're taking if you buy corporate bonds. But you usually get a better return to compensate you. And you can also buy other more exciting assets. One of those I've invested in myself is the classic car market. I own a classic car, and that has indeed gone up in price, and you might want to think about the mechanics of how that works. Or you could look at buying art, fine wine. The big challenge, of course, with any of these real assets is they're not typically very liquid. They're quite difficult to sell, and you probably need quite a bit of information about the asset before you buy it. So certainly if you're going to dive into the classic car market, you want to be certain that you understand classic cars pretty well. But those are certainly the options available to you in terms of things that you might buy. So since the world of investment is made up of lots of different asset classes, of which equity is just one, the challenge for you is to decide which asset classes you want to buy and how you manage each chunk of your portfolio. Now, looking at that from kind of top down, your portfolio should look something like this. This is a simplified, or maybe let's call it a stylized portfolio of one particular investor who owns 3 different types of assets. He owns equity. As you can see from the pie charts, that's the large majority of his portfolio, more than 50%. He's got a chunk in bonds. Let's say they're government bonds. That's somewhere just over 25% or thereabouts. And he has the rest of his money sitting in the bank on a bank deposit. Each of those separate asset classes requires separate management and an understanding of the risks that he's taking. So here's the secret sauce. Here's why his portfolio is a good portfolio. And we'll cover some more of this in a few moments towards the end of the presentation. Each of those asset classes is appropriate for different economic circumstances. And over time, the investor can vary the allocation between equity, government bonds, or cash as he sees fit. But of course, he's not always going to be right. None of us have a perfect knowledge of how the economy is going to perform looking ahead 1, 2, 3, 4, 5 years. But he knows that at some point in the economic cycle, one of those asset classes is probably going to be the one which generates the lion's share of his returns. And therefore he's always got some assets which are appropriate for different economic circumstances. That's the secret sauce, and we'll talk a bit more about that in a few moments. So what drives the performance of each of these asset classes? Why do they behave differently and generate different returns at different times? To answer that question, we're going to look at just a couple of the ingredients of your portfolio returns. Now, the first one here is the economic cycle. When the economy is booming, some asset classes will do better than others. And typically when the economy is booming, the asset class which is going to do best is equity. If the economy is headed into recession, the asset class which is going to do pretty badly, you guessed it, is equity as well. It is, to an extent, a simple play on the performance of the economy. Now, another factor which drives the performance of your returns is the interest rate cycle. As interest rates go up and down, this has a huge impact on the performance of your returns. Now, when interest rates go up, this may affect the equity market in a negative way because the market realises the reason why interest rates are going up is because the central bank is tightening monetary policy because it wants the economy to slow down. So over the longer term, this isn't great for equities, but it's certainly not very good for government bonds. This is the asset class which tends to perform worst in a rising interest rate environment. And what you'll see is the longer dated the government bond you might buy, so if you're going to buy something of 10 years or 30 years, that will perform especially badly. Yet when interest rates are coming down, this is when government bonds really perform. Because what you can do is you can lock in for 5 or 10 years at a relatively high rate of interest. So falling interest rates means government bonds perform well. Yes, it might help the equity market in the long term because falling interest rates, why are they falling? It's because the central bank wants to boost the economy and eventually that'll work and the economy will recover. But usually government bonds will perform better when interest rates are coming down first, and then equities will perform better at a later stage. So the interest rate cycle is absolutely critical for you. Now, what you can infer from this is that by understanding the economic cycle, by understanding the interest rate cycle, you can make good choices between putting your money in the equity markets when the economy is booming, putting your money in government bonds if you think the interest rates are coming down, and if you don't know which they're doing or nothing's happening, then maybe cash is the right place to be if you're in a weak economic environment and interest rates perhaps are going higher. So this gives you a sense that your asset allocation should be dynamic. It has to change over time. And because we don't get the full information about the economy, we never really know everything we ought to know about it. It means that you need to have a balanced allocation, which includes some elements of government bonds, some elements of equity, and some cash in the bank. That has to be your starting points. And once you've got elements of all three, you can then tweak the allocation according to what your view on the economy is and whether you think interest rates are going up or down. But there's 3 other things I need to share with you that will help you make a decision as to how much you want to have in equity, government bonds, cash, or other asset classes. The first one, and the most important one, is you. It depends upon your age. If you're retired, chances are you need income and you need to preserve your capital very, very carefully. And as a result, retirees often want to hold more government bonds because they generate a higher level of income than equities typically do. Not always the case, but they typically give you that, and they also tend to be less volatile than the equity market. Not always the case, but in general, they are less volatile. So often retirees want to hold rather more in government bonds than, say, a young person who's just starting out. They're, say, 25 years old, and they know that over the longer term, the best performing of these asset classes is going to be equity, and therefore the lion's share of their portfolio would want to be in equity. And of course, they have no need of the income from their savings because they're still working. So bear this in mind, that if you're retired, your bias towards safety, security, and getting income in is always going to be higher than it is for a young person. Your age is critical and your personal circumstances. Now, your demand for liquidity is absolutely important to determine your allocation. Why is that? If you think you're going to have sudden demands for cash to spend, let's say you may want to remodel your house, you may have a car purchase coming up, or you want to give some money to your children for them to purchase a house, you need to keep more cash on hand. Bear in mind, although equity sounds like it's liquid because you can sell it whenever you like, or at least most types of equity you can sell whenever you like, if you're selling in a down market, that timing isn't great, and therefore the best time to sell equity and realise cash is when the market's strong or when it's approaching a peak. So timing is going to be critical to your performance in the equity markets. The same is true with government bonds as well. Again, there are fluctuations in the market, and there's a good time to sell and a bad time to sell. And if you think that you're suddenly going to need cash, selling government bonds at a bad time is not a great thing to be doing. So that might bias you towards holding more in your bank account. Obviously, holding more in your bank account typically is not the best way of capturing long-time returns, but if you think that's the nature of your personal circumstances, then you have to take that into account. And the last thing you need to understand, absolutely critical, before you buy any asset class, you need to understand it, and you need to understand it really well. If you've decided you want to be involved in property, and property typically performs best when the economy is performing well and interest rates are low, that particular combination is ideal for the property market. You still need to understand whether you're going to buy residential or whether you're going to buy commercial, and how you intend to manage this property that you're going to buy. It seems like a very exciting asset class to be involved with, but do bear that in mind, and it applies to classic cars, fine wines, government bonds and equity as well. Getting the top level decision right is the first step, but actually understanding what you're buying is equally critical as well. So let's summarise some of the key things that we've covered here. It's absolutely important not to put all your eggs in one basket. The more diversified your portfolio, chances are the more money you're likely to make over the longer term. So looking at other asset classes besides equity is probably going to be a good thing in the future. Make sure that you understand those asset classes and accept that the amount you choose to allocate between them will firstly vary over time, and that will depend upon the circumstances of the economy, and is also a function of your own personal circumstances, what's right for you. But if you do get it right, it is most likely that over the longer term, you will be one of the better performing investors, because you've got the right allocation at a top level between asset classes, and then when you look at what it is you're buying within each asset class, you've made the best possible decisions there as well. So here's the conclusion. This is the secret sauce. Don't put all your eggs in one basket. Diversity is absolutely key to long-term success as an investor. I hope you found this video helpful. If you have enjoyed it, please do click the like button, please do click the subscribe button, and there are more videos coming along soon. Please also bear in mind we have paid courses which go into much more depth into each of these asset classes that I've covered today, and also go in much more depth as to how you manage the asset allocation process. But I hope today's video has given you a broader sense of how that process works. Good luck and happy investing.